XRP won every legal battle. It beat the SEC in court. The SEC and CFTC jointly classified it as a digital commodity on March 17th. 7 spot ETFs launched. Over $1 billion flowed in. And the price is down 63% from its peak. You read that correctly. Every regulatory win, and XRP is trading below where it was before most of them happened. So either the market is completely broken, or there is one single mechanism that none of those wins actually unlocked. And right now, that mechanism has exactly 3 weeks before the window closes permanently. Here's what makes this moment genuinely different from every other legislative headline you've ignored this cycle. Senator Bernie Moreno has gone on record. If the Clarity Act does not reach the full Senate floor by May, midterm election dynamics will bury it for the rest of 2026. Senator Cynthia Lummis has been even blunter. Miss this window, and Congress doesn't revisit it until at least 2030. That is a structural calendar reality. Galaxy Research's Alex Thorne calculated that with only 18 working weeks remaining before the midterm recess on October 5th, each week of delay makes 2026 passage mathematically implausible. The clock isn't ticking, it's expiring. So here's the question nobody is asking clearly enough. If XRP already has commodity classification from the SEC and CFTC, why isn't that enough for institutions to move? Why are banks, pension funds, and asset managers still sitting on the sidelines after the legal battles are effectively won? The answer to that question explains everything. Why the price is where it is right now, what specifically the Clarity Act changes, and what $4 to $8 billion in additional inflows actually does to a supply-compressed asset. We'll get there. But first, the macro framework, because none of this makes sense without it. This is XRP News Flow Signals. We track regulatory filings, legislative calendars, institutional positioning, and on-chain data. And we tell you what they actually mean for price without the narrative layer that most coverage adds. Let's get into it. To understand what's happening right now, you have to understand why the United States is treating digital asset legislation as a national priority, not as a financial innovation story, but as a geopolitical one. For decades, U.S. financial dominance rested on 3 pillars: the dollar as the global reserve currency, U.S. Treasuries as the world's primary collateral base, and American-controlled payment infrastructure, SWIFT, correspondent banking, capital market settlement. Blockchain introduced something that threatens all 3, not because it's more efficient, though it is, but because it's neutral. A programmable, decentralized settlement layer doesn't require American pipes to function. And if the next generation of global financial infrastructure is built on protocols the U.S. doesn't control, dollar dominance doesn't disappear overnight. It just becomes increasingly optional. Treasury Secretary Scott Bessent has testified explicitly that digital asset legislation is no longer optional for maintaining U.S. financial leadership. The argument is this: if crypto infrastructure is inevitable, the U.S. must define the rules before someone else does. That is the macro context. This is why the Genius Act passed with a 68-30 Senate vote in June 2025. That is why the Clarity Act cleared the House 294-134 last July. And that is why 120 companies, including Coinbase, Ripple, Kraken, Circle, and Andreessen Horowitz, signed a joint letter on April 23rd telling the Senate to move the Clarity Act forward immediately. This isn't lobbying. This is an industry telling the government the window is closing. But here's what that macro framing misses. And this is the part most coverage doesn't connect to the price. Because the Genius Act already passed. The stablecoin framework exists. So what exactly is still broken? That's next. On March 17, 2026, the SEC and CFTC jointly classified XRP as a digital commodity, placing it under CFTC jurisdiction alongside Bitcoin and Ethereum and stripping the SEC of primary oversight authority. That should have been a price catalyst of historic proportions. It wasn't. XRP rallied briefly and faded. Here's why. And this is the distinction almost nobody explains clearly. An interpretive release is not a statute. The SEC and CFTC issued a joint administrative determination. That determination can be reversed by the next administration with exactly the same kind of memo that created it. No congressional vote required, no public debate, one new SEC chair, one new political directive, and XRP is back in a gray zone. Banks know this, pension funds know this, state-regulated asset managers with fiduciary duties know this. They are not deploying capital at scale on the basis of an administrative classification that has no legal permanence. This is the mechanism. This is why the winds aren't moving price. The Clarity Act converts that interpretive release into federal statute. It embeds XRP's commodity classification into law in a way that no future administration can reverse without an act of Congress. That is the legal anchor institutions are waiting for. Not the court victories, not the commodity classification memo, the statute. And right now, that statute is sitting in the Senate Banking Committee, waiting for Chairman Tim Scott to schedule a markup date. While the American Bankers Association runs anti-stablecoin ads in Politico to buy more time. Now, before you read that as a clean bull setup, there's something you need to understand about the banking opposition. Because it's not just lobbying. There's a legitimate structural threat they're fighting to protect, and understanding it tells you exactly what the compromise actually gave up. That's coming right after this. The American Bankers Association isn't fighting the Clarity Act because they oppose innovation. They're fighting it because one provision, stablecoin yield, threatens something specific, their cheapest source of funding. Here's the mechanics. Bank lending is funded by deposits. Deposits sit in accounts earning near zero interest because depositors have had nowhere better to put them. Banks have extracted that spread, the difference between what they pay depositors and what they earn on loans, for decades. Stablecoins that generate yield change that equation. If a consumer can hold digital dollars earning 4 to 5% through on-chain mechanisms, rather than leaving money in a bank at 0.5%, deposit migration begins. And deposit migration compresses bank lending margins. That is an existential threat, not to banking itself, but to the specific profitability model banks have operated on for 30 years. Here's where the current legislation landed. Senators Tom Tillis and Angela Alsobrooks negotiated a compromise that was confirmed on March 20th. Passive yield on simply holding stablecoins is banned. Activity-based rewards tied to actual payments, transfers, or platform engagement are permitted. White House crypto advisor Patrick Witt confirmed the deal. OCC Chief Jonathan Gould then introduced a 376-page rulemaking to implement the Genius Act framework, which the crypto industry immediately said overreached. Coinbase's chief policy officer Fariar Shirzad stated publicly, Congress already settled this in Genius. Reopening it now only creates uncertainty. So the compromise exists, but banks are still negotiating. Senator Tillis has asked Tim Scott to push the markup into May, and every week of delay shrinks the legislative window while the midterm calendar gets closer. And that brings us to the part most channels won't say out loud, because it requires acknowledging real downside risk. The numbers on both sides of this trade are significant. Let's lay them out exactly. Standard Chartered's Jeffrey Kendrick has modeled this explicitly. If the Clarity Act passes, $4 to $8 billion in additional XRP ETF inflows, on top of the $1.44 billion 7-spot ETFs already pulled in without the bill as law. That scale of inflows would lock hundreds of millions of XRP in institutional custody, compressing circulating supply at exactly the moment demand increases. Price target range, $1.60 as initial resistance break, $3 to $5 by late 2026 as the institutional allocation cycle builds. Most analysts project $5 to $10 if the full bill passes with the commodity classification permanent. The second-order catalyst, Ripple's Federal Reserve Master Account application, which would allow banks to settle directly in XRP, would add another layer if it progresses alongside the legislation. Now the downside scenario. If Tim Scott does not schedule the markup before Memorial Day recess on May 21st, or if the markup happens but the committee vote fails, the bill is effectively shelved until 2030. Standard Chartered's 2026 XRP target in that scenario falls to $2.80 at best, a number they already cut from $8 when delays first materialized. If that failure coincides with Bitcoin breaking below $60,000, XRP's floor becomes 82 cents per multiple analyst models. Polymarket currently assigns 63 to 66% probability of 2026 passage. Kalshi had it at 69% as recently as late March. The odds have moved down, not because the legislation got worse, but because the calendar got shorter. Ripple CEO Brad Garlinghouse, who publicly projected 90% confidence, has already extended his expected passage timeline from end of April to end of May. That is a credible signal from someone with direct access to the negotiating room. If you're tracking this kind of signal-level analysis week to week, the subscribe button is right there. We don't do predictions without data behind them. That's the only kind of analysis worth building a position on. Institutional adoption doesn't happen all at once. It moves in phases, and each phase has a specific trigger. Phase 1, research, completed. Every major asset manager has an internal digital asset working group. Phase 2, pilot programs and limited product launches, completed. 7-spot XRP ETFs, Swiss ETP products, $120 million from Swiss institutional capital. Granite shares 3x leveraged XRP ETFs listed on NASDAQ on April 23rd. Leveraged products don't get listed for assets institutions have written off. Phase 3, limited institutional deployment. This is where we are right now. ETF inflows exist, but they're constrained to retail-accessible vehicles. Pension funds, 401k providers, state endowments, and institutional custodians are watching, not allocating. Phase 4, full-scale integration. The trigger for Phase 4 is permanent legal framework. Not a court ruling, not an agency memo, statute. The Clarity Act is the Phase 4 trigger. And once Phase 4 begins, the dynamics change structurally. Risk departments at major allocators adjust models. Compliance frameworks open. Capital that has been restricted for regulatory reasons becomes deployable, not in millions, but in the context of portfolios managing trillions of dollars. That is the transition these 18 working weeks are deciding. Timestamp 8:15 to 9:15. Let's close the loop on where XRP stands technically heading into this legislative window. Exchange reserves have fallen to a 7-year low of 1.7 billion XRP. The 50-day moving average recently crossed above the 200-day, a golden cross formation on the daily chart. RSI sits around 54, neither overbought nor oversold. Bollinger Bands are compressing around the $1.40 level. The technical setup is coiled, not broken. 3 scenarios for the next 4 weeks. Scenario 1. Tim Scott schedules the markup before May. XRP breaks above $1.45, tests $1.60 resistance. ETF inflows accelerate. Institutional custody demand tightens supply. Scenario 2. Markup is delayed past Memorial Day. XRP returns to tracking Bitcoin. Range-bound between $1.15 and $1.35 through most of 2026. Scenario 3. Markup happens, but the committee vote fails on DeFi provisions. Market reads it as 2030 delay. Price tests $0.82 support. This is the tail risk that prediction markets aren't fully pricing. The variable to watch this week, whether Chairman Tim Scott puts the markup date on the banking committee calendar. That single scheduling decision is the most consequential event for XRP price between now and June. Here's where we land. XRP has won the legal arguments. The SEC dropped its case. The commodity classification exists. The ETFs are live and pulling in capital. 120 companies signed a letter this week demanding the Senate move. And it is all sitting on hold, waiting for one Senate committee chairman to put a date on a calendar. That is the honest picture. The macro direction has not changed. The U.S. is building the regulatory framework for the next generation of global finance. And XRP is positioned at the intersection of that framework's most critical components: cross-border settlement, tokenized asset liquidity, and real-time programmable payment rails. But positioning without legal permanence is still positioning in a gray zone. The Clarity Act passage is not just a bull catalyst. It is the mechanism that converts every prior wind into something institutions can act on. May 21st is the hard deadline. 3 working weeks, the most consequential legislative window XRP has faced in its entire history. Watch the Banking Committee calendar. Watch Senator Tim Scott. Watch whether the stablecoin yield compromise holds or gets reopened by the OCC rulemaking. Those 3 variables will tell you more about XRP's price structure through the rest of 2026 than any chart pattern or price model. This is XRP News Flow Signals, data over narrative.